Let's be real, zero DTE trading is flooded with hype, half-truths, and flat-out BS. You'll hear things like, it's risk-free if you manage it right, or you can print money every day with the right setup. But how much of that is actually true? Today, I'm breaking down the biggest myths I see traders fall for and what you should believe instead. If you're new here, I'm Mark Anderson, construction worker turned zero DTE hedge fund manager. I've sold over 100 million in zero DTE premium across over 1,000 consecutive trading days. We've tested nearly every zero DTE approach out there, and I've seen firsthand what works and what just sounds good on Twitter. So let's get into it. Myth 1. Zero DTE is safe if you can just cut your losses quickly. This is one of the most dangerous beliefs out there. A lot of traders think safety is equal to tight stops and small position size. On paper, it looks reasonable, but in practice, it's riskier than they realize because it assumes two things. One, you'll always be able to get out and cut your losses fast enough. And two, you'll always want to take a 50 wide spread with a 1x stop, and it sounds conservative. But it caps your reward and creates more losses, and most of the profit gets eaten up by commission, slippage, fees, and buying power usage. Then volatility spikes. Your stop gets skipped, or you freeze in the moment, and the damage is done. Suddenly, that safe trade costs more than you've ever earned doing it. The truth is, risk is the cornerstone of how we make money. If you don't take any, there's no premium to collect. The real damage isn't taking risk. It's misunderstanding the risk that you're taking. A tight, frequent stop system with small returns is often more fragile than a wider spread size appropriately sized because when trouble hits, structure and sizing, not stop losses, determine how well you end up surviving. Safety doesn't come from being cautious. It comes from being calculated. Myth 2. High win rate is automatically a good strategy. It's tempting to chase 95% win rates. It looks clean on a back test, it feels good to avoid losses, but that illusion comes at a cost. Because most high win rate strategies hide tail risk. They win small often until eventually they lose big. You can make $100 9 times, then lose $1,500 on the 10th, and suddenly your edge, gone. Even worse, if your win rate drops from 95% to 90%, just a small shift, your drawdown nearly doubles. Here's a better frame. Roger Federer, arguably the greatest tennis player of all time, only won 54% of the points he played. Half, that's it. But he still won 76% of his sets and 84% of his matches. He didn't win constantly. He just lost really well. The truth is, high win rates are psychologically appealing, but mathematically fragile. These strategies often rely on curve fitting and over-optimization. They lure you into the delusion of thinking, I've found the lost city of Atlantis. They filter out the few big losses until one slips through. But I'll take my 60% win rate any day. It's not flashy, but it's consistent. It's profitable, and it's survivable through multiple market crashes. The best performing strategies aren't always the ones that win the most. They're the ones that lose well and survive the worst days. Myth 3. Selling premium daily is the fastest path to consistency. Daily trades, daily theta decay, daily income, right? Sounds great. Until the market gaps against you and you don't have time to adjust. It sounds like a consistent system, but don't confuse activity with edge. Just trading every day doesn't make you consistent. It makes you busy. The truth is, consistency is built through compound knowledge. When you run a repeatable strategy and stick with it, your edge doesn't just show up, it grows. Even a small edge, compounded over time, creates big results. And that's especially true with short duration strategies like zero DTE, because they adapt faster and price and information is quicker than in longer dated trades. Some of our best strategies don't fire every day, but when they do, they're precise, efficient, and repeatable. So if you're chasing daily trades for the sake of routine, you might be skipping right past the setup that actually works. Myth 4. You don't need to hedge if you size responsibly. That sounds smart. Just risk 1% per trade and you'll be fine. But when volatility clusters or market moves violently, even small positions can pile up fast, especially if you're scaling and overlapping trades that are all correlated. And in a fast market, those controlled risks can spiral before you have time to react. The truth is, SPX is your baseline. It moves on average 85 basis points a day to 1%. So if you're trying to outperform the S&P from a return on risk perspective, you should be more than fine with a 10% drawdown. Trying to hedge away every 1% bump is like fearing weather in a climate-controlled room. Most traders spend way too much time building the perfect backtest, but forget that the real businesses aren't built on PowerPoint decks. They're built on conviction, flexibility, and calculated decisions. Multi-million-dollar businesses have been sketched on the back of a napkin. Your strategy should hold up the same way, even when conditions change. And let's be honest, hedging is a luxury. It's hard to do well without a seven-figure account. You're trying to manage a $600,000 instrument in SPX, so it's not just about knowing how to hedge. It's about having the capital to do so. That's why we prioritize what works at any size. Smart sizing, diversified edges, asset allocation. Think of it like insurance. Most people don't have platinum coverage with zero deductibles. They get catastrophic coverage, protection against the thing that wipes you out. Sizing is your seatbelt. Hedging is your airbag. And diversification, that's driving a car that's built to handle rough roads. Myth 5. The more complex the strategy, the better it performs. A lot of traders fall into the trap of over-engineering. They add filters, they tweak the parameters constantly, they chase perfection with spreadsheets and backtest, but all they're really doing is curve fitting. The truth is, complexity doesn't protect you, it weakens you. The more knobs you have to turn, the more fragile your system becomes. The best performing strategies are so simple. They work because they're built on timeless principles. The market rewards risk. Trends exist because humans are emotional. Companies innovate and create value over time. As one of my favorite quotes puts it, price shows you predictable behavior of how humans react to fear and greed. If your strategy only works with 12 filters and an over-optimized entry to the third decimal place, it probably doesn't work. If you can't explain your edge in one sentence, you probably don't have one. Simple strategies that last, because human behavior doesn't change and neither should your core logic. If any of these myths sounded familiar, don't worry. Most traders, even advanced ones, fall for them from time to time. But recognizing these traps is the first steps toward building a strategy that actually lasts. If you want more breakdowns like this, including how I build strategies that survive shocks, handle volatility events, and manage real capital, make sure to subscribe and let me know in the comments. Which of these myths tripped you off, and what else do you think most traders get wrong about 0DT? I'll see you guys in the next one.